Dear clients, welcome to PhillipCapital's Weekly Market Watch. My name is Nicholas, investment analyst from Phillip Securities Research. This week, we will be talking about the offshore and marine sector. The recent earnings season ended with no major surprises among the rig builders. Keppel's results were mostly in line. Earnings were down year-on-year, mainly due to substantial property income reported in first quarter last year. Revenue from its O&M sector was slightly lower than expectations, but this was supported by strong margin improvement. Submarine's results were slightly below expectations due to its low revenue recognition, which was offset by a positive margin surprise. First Q 2013 has been a healthy quarter in terms of order wins for Keppel, as it bagged $1.7 billion worth of contracts. This included a $1 billion contract from Grupo R for 4 jackup rigs based on its proprietary K-Fel's B-class jackup rig design. Similarly, Submarine fared well with a total new orders of $1.7 billion as well, including $780 million worth of contracts for 3 jackup rigs based on the repeat proprietary Pacific's class 400 jackup design. In terms of operational performance, it is evidence that margins at both companies have gone up from the lows in 2012. Keppel's operating margin rose quarter-on-quarter from 12.9% to 14.1%, despite conservative profit recognition for its first CETA Brazil semi-sub unit. Submarine's operating margin also jumped quarter-on-quarter from 10.8% to 13.7%. However, we see potential downside to margins as revenue recognition for Submarine for its new design semi-sub rigs, which yield lower margins, commence. Despite rising competition from the Chinese yards, we think downside risks to Singapore yards are limited in the near term due to the lack of track record from the Chinese as well as late delivery concerns. In fact, Singapore yards have managed to raise pricing by about 15 to 17% for their proprietary designs over the past 2 years, even though the Chinese peers have aggressively entered the offshore market with lower pricing and attractive payment terms. We continue to like Keppel for its stronger operating performance, better execution for its Brazilian projects, and potential upside margin from the delivery of remaining 15 jackup rigs for the rest of the year. 5 already delivered in first Q. Although Submarine's order book spike of 150% last year will see higher revenue growth over the next few years, we believe margins will continue to face pressure as they need to pay learning curve tuition fees for the execution of new design rigs, which in turn affects earnings. That's all we have for you today. Do stay tuned to next week's video. Thank you.